Hello everyone, I'm Matthias and today we're talking about Meta and Microsoft's latest earnings. Now, I hold both companies in my portfolio, with Meta being an 11.2% position and Microsoft, my latest addition, being an almost 3% position. Now, I'm gonna upload a video very soon about my Microsoft thesis. It is ready and it's ready to be uploaded, but I wanna get this video out first. In my opinion, both companies delivered strong, solid earnings, both growing very well in terms of the direction they both respectively want to grow into. Microsoft boasting immense Azure cloud growth, Meta boasting immense growth in revenue, ad prices, ad impressions, and also their user base. But when it comes to the market reactions to these earnings, we can see the market not being too enthusiastic about the Microsoft earnings. Even though I think they're wonderful, they're beautiful, their cloud backlog just had a huge explosion, right? Whereas the market really appreciated Meta's earnings report, boasting strong revenue growth and all these things that I just mentioned, also increasing their capital expenditures to a huge degree. I'm gonna take a look at both companies' earnings reports and tell you my thoughts on them. When it comes to the Microsoft earnings, I'm not gonna dive too deep into them because I still have my Microsoft thesis that I'm still yet to post. Overall, we saw the company boasting a double beating on EPS and on revenue as well, but the stock market did not like the report. So even though the company boasted great earnings, the market didn't like the report, whereas I truly and utterly love this report. I think the reason why the market didn't quite like this report is a combination between two things. Azure growth slowing down, while also having a huge part of their remaining cloud backlog being tied up to OpenAI and to Anthropic. As we can see right here on this page, we see their commercial remaining performance obligations growing by a huge degree, going from almost 400 million to 625 million. This is a huge explosion in the remaining performance obligation growth. But the reason the market probably does not like this is that roughly 4 to 5% of the commercial RPO balance is driven by commitments from OpenAI. The remaining balance from the broad customer base grew 28%, with benefit from the Anthropic commitment. So most of this RPO growth is based on OpenAI, and the market probably does not like the concentration of this growth being tied up to such a degree into OpenAI. This, in my opinion, is a great example of market sentiment switching so fast. Just 1 year ago, OpenAI was the Google killer. Now Google is the OpenAI killer. Now Microsoft, having a huge degree of their remaining performance obligations tied into OpenAI, is a huge bearish sign to the market, whereas I think that it's great. I think that it's so great that Microsoft are working together with this wonderful company, up-and-coming company, that is going to take a huge market share in terms of frontier models and in terms of AI labs, right? So that's just my opinion, but this is just a great example of market sentiment switching. What we see here is sentiment switching and turning negative while Microsoft actually grows their RPO. The market is afraid that these bookings won't turn into revenues in the future, right? But what we see here as well is Azure growth slowing down, right? So it went from growing on a constant currency basis of 39% to 38%. The market sees this relative slowdown in growth and it's getting skeptical about it. But what is really impressive to me is that they're growing at such high numbers, right? So growing 38% at such a high scale is actually growing this revenue by $51 billion in a quarter, right? So this is immense growth. This is insane growth on such a huge scale. I'm not afraid of this growth rate declining somewhat. If it's above 35%, this is just insane. This is crazy growth. So going back into it, this cloud revenue growth is immensely profitable with gross margin percentages of 67%. These margins are also somewhat contracting from 68% to 67%. But this is, as they say, driven by continued investments in AI infrastructure and growing AI product usage. So this is basically Microsoft spending in order to survive. In this AI build-out phase, companies such as Microsoft, these hyperscalers, just have to spend immense amounts of money. This is in order to gain more money in the future. As soon as they gain more cloud capacity, they sell it out. So the more they can buy, the better for them, right? Doing so at gross margins of 67%, this is an insanely profitable business, growing at 38%. So this is just completely mind-boggling to me. LinkedIn is growing by 11%, which is also pretty bullish to me. But what is the most crazy thing to me is that their productivity and business processes, so the Office package, right, is growing by 14%. This is insane. This is incredible. Microsoft is one of these unique companies that's able to grow scale and able to grow prices. So they're able to grow the amount of customers while growing the prices that the customers have to pay. So this leads to the 14% growth in this metric, right? We're seeing immense growth all over the board, almost just apart from their gaming segment, right? Which is falling behind and lacking. But overall, Microsoft is growing and growing steadily in the correct direction. Now, the directional growth and the directional trajectory of this company is still good. This company's growth trajectory and their place in the future with AI, with the AI platform they're building through Azure is still intact. Now I'm seeing this company just growing directionally in the right direction with immense growth rates, with huge margins. Now, from sour market reactions to a great earnings report, we go to optimistic market reactions to a great earnings report. These two respective reports are both brilliant, but basically what we see in terms of these meta earnings is that they're able to grow the amount of users, the ad impressions, and the price per ad we see, while also boosting up their AI CapEx spend. Now, I still don't think the market has fully captured just how much value that Meta can create with this CapEx expenditure, which is why I purchased shares in the first place. I purchased my shares at around $360 in November of 2025. Doing this on the basis and on the thesis of the broad market just does not understand how much value that Meta can create with their AI expenditure, boosting their family of apps, boosting their ad recommendation systems. I think the market fundamentally misunderstands Meta. The worst case scenario for this Meta compute expenditure is the Meta cloud, which they're starting to build, the Meta compute, right? So this is the worst case scenario. Best case scenario that the market still does not get is just how much effective Meta gets when they spend money on their core businesses. They have immense return on invested capital. So when a company with high return on invested capital starts spending money, starts gaining and boosting their capital expenditures, you should be bullish. We see Meta here going into fiscal AI. We can see that the return on invested capital is 29%. We see that their free cash flow margins are 23%. So them growing their revenues by over 20% in the fourth quarter, we're going to get into that. We're going to see that this is going to accrue to huge free cash flows in the future when they stop spending this much money on their cloud infrastructure, on their compute, on improving processes for their employees, right? So this company is incredibly profitable with immense returns on invested capital. So when they start spending money on CapEx, you should be bullish. They're good at spending money, but the market still doesn't get the fact that they can't directly measure the ROIC in the short term because they don't have cloud infrastructure to sell out. The Meta compute is used in other ways. They're used to boost core business metrics, core fundamentals, and value creation processes. We're going to get into that shortly. So overall, we see their revenues growing at 24%. So this is immense revenue growth and doing so at this scale. So their revenue growing at a 22% rate on a basis of $164 billion means that they have a revenue of $200 billion for the last 12 months. This is immense revenue growth. With the profitability of this company, we're going to see this accruing and this leading to free cash flow in huge scales in the future, but not now as they're increasing their CapEx expenditure. We're going to look at that. So yeah, we see their advertising revenue growing immensely, now boasting it at $58 billion for Q4 2025. This is incredible, but this is also seasonal. As we see, Q4 usually is a strong quarter because of ad spending up to Christmas and then the holidays, right? The most interesting things is Meta being able to grow this community that they've built, now having over 3.5 billion users. This is just crazy, right? So it's almost 40% of the total world population being active on one of Meta's platforms. On the earnings call, Mark said that they have over 2 billion people active on Facebook and 2 billion people active on WhatsApp, with Instagram just trailing that, short of 2 billion people active, right? So this is a huge community and it's a huge platform that they can use to cross-sell, get data in, show you the ads. Meta, my thesis of Meta is this that I just mentioned, right? So they have this huge boost in their fundamentals in terms of spending money on their content recommendation. But another thing is just one of the best billboards in the world. They have so many people watching, they have so many eyeball hours, they have so many people on their surfaces. This means that their average revenue per person still keeps on growing. We can see here growing consistently over time because they just are the best platform for interest-based ads. They are the best billboard in the world for this. We see it growing immensely. They are able to create so much value for advertisers because of their expenditures on AI. Meta becomes so much more interesting for advertisers just because it becomes so much better to advertise on. They're becoming increasingly better at matching content with users. They just said this in the earnings call.
There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, we're continuing to drive incremental engagement from ranking and product improvements. Instagram Reels had another strong quarter, with watch time up more than 30% year over year in the US. Engagement is benefiting from several optimizations we made to improve the quality of recommendations, including simplifying our ranking architecture to enable more efficient model scaling.
Another thing that is interesting to me is their ad impressions now growing at 18%. So what we see here is Meta growing the amount of people using their platform. They're growing the ad impressions on the platform, so the amount of ads that customers get exposed to, right? But what is interesting as well is that the average price paid per ad is also increasing by 6%. So what we have is a multitude, is a cocktail, is a delectable medley of wonderful inputs in order for Meta to grow their revenues, to grow their cash flows in the future. They have a growing amount of people on their platform. They have growing amount of ad impressions while also increasing the price per ad, while also increasing the value propositions for people advertising on the platform. But what I'm really interested in here is the fact that they increased their capital expenditure guidance. They say here, we anticipate 2026 capital expenditures, including principal payments on finance leases, to be in the range of 115 to 135 billion, with year-over-year growth by increased investment to support our Meta Superintelligence labs and core businesses. So you already know probably Mark Zuckerberg and Meta's vision for Meta in terms of being the lab, super lab for AI development, right? So they want Meta to deliver super intelligence. They want to increase and make the experience on their platform better by using and integrating AI onto the platform so that you engage with artificial intelligence, so that you get AI delivered content, so that you get AI delivered posts on your platform, right? Tailored directly to you, and then you can engage with it, you can talk to it. These are the visions of Meta. But what is incredible to me is just how much AI expenditure actually improves their core businesses. So now I'm going to play you a clip of Jensen Huang from NVIDIA talking about how Meta spends money on AI to improve their content recommendation systems and how this drives further engagement on the platform. This is going to be followed up by Meta's management commenting on these same things as well. So let's hear what they have to say.
In their current business models, recommender systems drive the world's hyperscalers. Every single, whether it's watching short form videos or recommending books or recommending the next item in your basket to recommending ads to recommending news it's all about recommenders. The internet has trillions of pieces of content. How could they possibly figure out what to put in front of you in your little tiny screen unless they have really sophisticated recommender systems to do so? Meta's GEM, a foundation model for ad recommendations trained on large-scale GPU clusters, exemplifies this shift. In Q2, Meta reported over a 5% increase in ad conversions on Instagram and 3% gain on Facebook feed, driven by generative AI-based GEM.
Across Facebook, Instagram, and Threads, our AI recommendation systems are delivering higher quality and more relevant content, which led to 5% more time spent on Facebook in Q3 and 10% on Threads. Video is a particular bright spot, with video time spent on Instagram up more than 30% since last year. And as video continues to grow across our apps, Reels now has an annual run rate of over $50 billion.
So spending money on artificial intelligence increases Meta's core business value proposition. But this isn't everything. Meta is one of these companies that uses artificial intelligence to do A/B tests, and Mark Zuckerberg has explained that they have been compute constrained to run these tests in order to improve their platform and figure out what works and what does not work. So I'm going to play you a clip now by Mark Zuckerberg talking about this.
We had a project on, he was on our ads team, to automate ranking experiments, right? That's like a pretty constrained environment. It's not like write open-ended code. It's basically look at the whole history of the company, every experiment that any engineer has ever done in the ad system, and look at what worked, what didn't, what the results of those were, and basically formulate new hypotheses for different tests that we should run that could improve the performance of the ad system. And what we basically found was we were bottlenecked on compute to run tests based on the number of hypotheses. It turns out even with just the humans that we have right now on the ads team, we already have more good ideas to test than you actually have either kind of compute or really cohorts of people to test them with, right? Because I mean, even if you have like 3.5 billion people using your products, you still want each test needs to be statistically significant. So it needs to have, some number of whatever it is, hundreds of thousands or millions of people. And it's there's kind of only so much throughput that you can get on testing through that. So we're already at the point, even with just like the people we have, that we already can't really test everything that we want.
So they wish they would have much more compute to run these tests, to run these simulations. Now, this is going to improve Meta's core business in one fundamental way. We have AI improving content recommendation systems, which leads to more engagement, which leads to more value creation for their advertisers, right? Because they can drive up ad impressions because these ads are relevant. They can match the right ad to the right customer. But the other thing is that that each individual Meta employee gets much more effective. Let's hear what Mark Zuckerberg has to say about this.
We're investing in AI native tooling so individuals at Meta can get more done. We're elevating individual contributors and flattening teams. We're starting to see projects that used to require big teams now be accomplished by a single very talented person.
So a lot of different processes get fundamentally improved because Meta spends money on artificial intelligence. This was what I said in one of my Danish videos when I explained why I purchased my shares of Meta. They just exponentially improve their value proposition for customers and for advertisers, leading to growth, leading to better revenue growth. This company is incredibly profitable, as we just saw. So this accrues to free cash flow over the long term when they stop spending this much money on their AI buildouts. But right now they're focused on doing this. And you should be very bullish as a Meta investor because they have such high returns on invested capital. You see these things, you see these investments accruing to much better retention rates, much better time spent on the ads, much better time spent on these surfaces, which leads to Meta being able to drive up ad impressions and drive up prices per ad, and in the long term, drive up the users on their platform. Now, we haven't seen too much in terms of WhatsApp monetization and Threads monetization, but this is going to come in the next couple of quarters of 2026. I think these are going to be immense growth drivers for Meta. I think these are going to lead to incredible value creation for Meta. Now, Meta creates huge value when they invest into their core business. We're going to hear Mark Zuckerberg talking about this, just qualitatively how much value is created when they spend money into their core business, driving up CapEx on that front.
There are several major business opportunities that we're focused on. I think that one is just going to be improving the core products and accelerating the current business. I talked about that in terms of the connecting of the recommendation systems and the LLMs, which I think will both improve the quality of the organic experience and of advertising. We're going to see the generation of media improve the quality of content, which coupled with the improvements in the recommendation systems, we expect to generally accelerate the quality and effectiveness of the core business, both for people who use it organically and for businesses. So I think that.
So they're looking at their core business as a key place to create further value, which is which is one of the elements of my Meta thesis. But my thoughts overall on the Microsoft and Meta earnings are basically just shortly said that these companies are driving themselves in the right direction. Both companies are steering themselves towards better and higher value creation. They're doing this in their respective ways. And I think directionally, the companies are on the right trajectory to be huge benefactors of artificial intelligence and of this movement going on. So later I'm going to post my Microsoft thesis. It's not going to go into depth with Azure, with Office. It's just going to be an overall thesis where I explain why I purchased the shares and all these qualitative and quantitative deep dives into each respective segment of the company are going to come and follow. Now I'm going to also I did a long video in Danish, but I'm also going to do a long video on Meta and why I purchased shares of that company. But overall, I'm very, very happy with both of these reports. I'm very, very stoked with being an owner of these companies. Now, I appreciate your time. I hope that you learned something, and I hope that you're happy with these beautiful, wonderful reports as well. Thank you for watching, and I'm going to see you in the next one.